CIS, looking at all of these factors, says things are likely to break to the downside for markets versus the upside. Joining me is Bob Dahl. He's Chief Investment Officer at Crossmark Global Investments. Bob, thank you so much for being with us. Walk us through your view on why you're more concerned about that downside breakdown.
Still believing, Amber, that we're going to have a recession here in the U.S. The lead economic indicators are now down 12 months in a row. That's a record. We still have an inverted yield curve. Money growth has failed us. So the lead indicators for our economy are lean to the negative side. Yes, it's been anticipated by so many for so long, but the impact of what the Fed does takes a long and unpredictable time to affect the economy. Remember, the U.S. Central Bank raised rates from 0 to 5% in a little more than a year. That has massive implications. We've already seen it with a few banks failing. I think the financial system still has some more challenges, but more importantly, think that it will lead to an economic slowdown / recession before this year is out.
That's not priced in, I guess, is the follow-up question.
Yeah, a great question. As you point out, we've been bouncing around, kind of going nowhere. We're at the higher end of S&P 500, 38 to 4,200. But we look at the PE ratio in the U.S. stock market, for example. It's over 20 on trailing earnings, almost 19 on forward earnings that are probably too high. So the market is anticipating things are okay, and they're generally okay. Look, last year was the bear market. I'm not saying we're going to repeat another down 20, 25%, but I think the sloppiness will come back and we may break to the downside on that trading range if we have a recession and declining earnings. And
I think technically we're still in the bear market, right? Because we haven't seen a rally of more than 20% from those lows. Having said that, a lot of this hinged before the banking crisis, at least, on where inflation was going. And you can slice it and dice it however you want to confirm your narrative. But broadly, inflation is coming down, and it's coming down. Bespoke actually noted this. It's coming down at a faster pace than it went up. Does that not give us some comfort that maybe it's working, the tighter monetary policy?
It is definitely working. It is definitely bringing inflation down. But the question will be at what expense? That is, will the economy succumb? Inflation's come from 9 in the United States to 5, maybe high 4s. The Fed's target is 2. That gap is still a pretty big one. I think we'll come down a little further without a whole lot more action, but I don't think we'll achieve 2. And then the Fed has the rock and the hard place to deal with. They do further tightening, and that will endanger the economy. If they don't do further tightening, maybe the economy's okay, but does inflation come back? We still have a problem with rent inflation, with wage inflation, and a reasonably strong labor market, as you know.
So what's the so what of that? An investor hearing what you're saying, looking for downside protection, where do they go?
Yeah, look, cash in the U.S. is you can get a 4 to 5% return on short-term paper. That's not a bad place to have some of your money. Within the stock market, I'm an equity investor and have to be invested in those equities. So I'm looking for companies that have high predictability of earnings delivery, good cash flow, companies that can withstand a sloppy economy should we have one.
So one of those is Cigna. What are kind of the moats around this that allows it to withstand, as you call it, the sloppy economy?
Yeah, so Cigna has, first of all, a PE ratio of 10 times earnings. That's kind of half the market, and yet through thick and thin has generally produced low double-digit sales growth, earnings growth, revenue growth. It's one of the premier health maintenance organizations here in the U.S., has its finger in lots of different pies and a good diversified business, continues to make tuck-in acquisitions. So I think the risk reward here is favorable in this uncertain environment.
Yet it has come off from the gains that we saw through much of 2022. So certainly what worked as a counter-cyclical stock. We think about insurance stocks benefiting from a rising rate environment. Why the recent pressure?
Because exactly what you mentioned, the stock was so strong last year, it ignored the bear market. The stock was up nearly 100 points, and year to date is down 20%. And that's part of what attracts me to it. When I can get something that's got good long-term potential and reasonable short-term potential at 10 times earnings, that gets my attention.
So you're worried about, the economy, and yet one of your other plays is Visa, which, is the pulse of the economy. It's, the railway to payments, and it has done very well. It's been resilient as the consumer has been resilient. You mentioned valuation on the other one. I don't think you can call this a cheap stock.
No, and never claim it's a cheap stock. Yeah. It's an expensive stock. It sells at 26 times earnings.
So what's the play here?
The play is mid-teens. Same variables, mid-teens revenue, earnings, and cash flow growth, high earnings predictability, good quality of delivery of those earnings. Again, I want this predictability factor in this uncertain world. They don't have to be cheap stocks, but they better produce the results, I guess, in the way to put it. Visa, along with some other big names like MasterCard, continuing to gain share overseas. Some of their non-U.S. businesses are growing north of 20% as they gain market share and provide ease in credit card transactions.
Okay, the last one, which also I have to say kind of seems, if you're worried about the economy and the consumer, Lowe's, right? You need a strong housing market. You need a consumer willing to kind of spend there. How does this make the cut?
So I'm a portfolio manager, and I do not put all my eggs in one basket. The basket you're referring to is defensive stocks. I have a lot of defensive stocks, but that's not the only thing I have. Among the consumer names, I want names that have higher, I'm going to repeat myself, predictability. Lowe's fits that bill very well. They're gaining market share. They're raising profit margins in what's been a pretty tough environment. The renovation business, Amber, you probably know, is still going pretty well among homes and other small buildings.